Hi, this is Michael Joyce with JoycePayne Partners, and I'm pleased to share with you our thoughts and viewpoints for the spring of 2016. We've really had kind of a wild year so far during 2016. In January and February, investors had, in essence, a panic attack with really no specific cause. A lot of it was blamed on low oil prices and the slowdown in economic growth in China. But really, those were factors that had been in place for much of 2015 and had been worries throughout the prior year. So there was really no specific cause for that other than investor psychology, which then flipped in February. Investors went from looking at things in the most pessimistic tones to looking at them through a lens that at least was a little bit more pragmatic. So for the quarter that recently ended on March 31st, the stock market ended up, the U.S. stock market ended up pretty much where it started the year. But in between, there was the worst start to a calendar year ever, and then a pretty furious comeback. Some smaller company stocks and the NASDAQ index, they were down for the quarter because they were down more in the first several weeks of the year, even though they then had a pretty big comeback. Also, some of the international developed stock markets were still down for the year, but there was really some impressive returns from the emerging markets. And if you recall, last year during 2015, the emerging markets really had a tough year. But as I said, they made a pretty big comeback and have had some impressive returns for 2016 to date. And really that was a theme for a lot of investments. Some of the things that did the worst in 2015 and the first several weeks of 2016 are what has done best subsequent to that time frame. It's also been a very good time to have a diversified portfolio. Now, we're big believers in diversification. I mean, we think people that have diversified portfolios will have better risk-adjusted returns over the long term, over an entire economic cycle, over an entire market cycle. But during 2014 and 2015, having a diversified portfolio really didn't help that much. But again, things have kind of flipped this year, and it's been far better to have a diversified portfolio. So now, with this rally in the stock market, U.S. stocks are back to where we think they're fairly valued. They're not cheap, but they're not really that expensive. Now, there are some sectors, like the electric utility sector comes to mind, that have gotten really expensive compared to their cash flow growth expectations. And we've been pruning some of those positions over the past couple months. But there's many other sectors that still look pretty decent. We are wary that if interest rates rise, price-earnings multiples could come down, and therefore that would lead to lower valuations. But one of the areas that has really done well in 2016 so far that could continue to have legs are in the stocks of companies that pay good dividends. And what I'm talking about are companies that have paid healthy dividends for decades without fail, through good times and bad times, through financial crises and booms. Now, those types of companies really didn't have a great year in 2015 on a total return basis. They paid good dividends, but their total return was down during 2015. And that's because most of these companies are multinational companies. They do business overseas. So last year, there was amazing strength in the U.S. dollar. The U.S. dollar rose significantly against almost every other currency in the world. And I'm not just talking about the emerging markets. I'm talking about more developed markets like the Canadian dollar, like the Australian dollar, etc. So when these companies had earnings overseas, when they converted those earnings back in U.S. dollars, they suffered a currency loss. And if you recall, at the end of last quarter, we had suggested that this tremendous rally in the U.S. dollar may be a little bit overdone, and there might be a little bit of a modest pullback. And that's actually what's happened. So a lot of these big multinational companies that pay good dividends, they aren't seeing the currency headwinds that they had last year, and probably won't, at least for the foreseeable future. Now, corporate bonds also had a really wild quarter. They were down significantly on their bid price, which is the price you get if you would want to sell the bonds before maturity, in the first part of the year in January and in early February. But that was a continuation of a downturn that happened in the second half of last year that really accelerated towards the end of the year. And this is a really important point. A big thing that has caused that, the volatility in these markets, is something that I haven't really seen in over 30 years in this business, and it's an unintended consequence of regulation. And what I'm talking about is specifically is the Volcker Rule of the Dodd-Frank Act and Basel IV, because these regulations have had the unintended consequence of taking market makers out of the market. So primary dealers of bonds that might have put a bid in for some of these bonds as they were falling, they weren't doing that. And at some points in January and early February, many corporate bonds were getting no trading whatsoever. There was no buys and no sells. But that market also has had a pretty furious rally as investors recognize there's some bargains. And frankly, I wish that we had taken advantage of some more bargains during January and February. But now those have moved up fairly significantly. We also wanted to spend a little bit of time this quarter talking about taxes, everybody's favorite subject. Most people have just filed their tax returns on tax day, except for people like me that file extensions because we have a ton of K1s out there. And you might think, well, I don't need to think about taxes anymore. But now is a perfect time to not file away that tax return in a drawer or electronically, but to dust it off, take a look at it, and look at tax planning opportunities. For example, we think that people should be looking at their withholdings and if they're paying quarterly estimated taxes, take a look at that. And the big thing is we don't want you to overpay. I mean, it may be nice to get a big tax refund, but in essence, you're giving the government a tax-free loan several months in advance, and we'd rather have our clients enjoy the use of those funds prior to getting a big tax refund. But the most important thing is to get that right, and that requires some planning. There's also opportunities to look at contributing to 529 plans for higher education costs for children or grandchildren. Most state plans do have a deduction on state income taxes for contributions to 529 plans. It's also a good opportunity to look at planning for capital gains that might be incurred during 2016. A few years ago, actually, the capital gains taxes were changed for long-term capital gains. There was a new bracket that was added, the 20% bracket, but there's not many people that fall into that 20% bracket. You have to have taxable income, and I'm talking about income after your deductions and exemptions, of over $450,000 if you're a joint tax filer to be subject to that new 20% long-term capital gains bracket. There's also been an expanded 0% bracket, and actually a lot more people than you might think fall into that 0% long-term capital gains bracket. And if you do fall into that bracket, that kind of turns the traditional tax planning for capital gains on its head. So it's a good idea to go and talk to your financial strategist at JoycePayne Partners and go through some of the tax planning, including planning for capital gains taxes this year, and to also provide them with your tax returns for this year, which is a treasure trove of information and provides opportunity to do some optimal tax planning. So I've been very pleased to give you our thoughts and viewpoints for the spring of 2016. If you want to know more about our ongoing thoughts, follow us on our website, go to JoycePaynePartners.com, or follow us on Twitter at JoycePaynePTRS. Thanks a lot. Have a great day.